After maintaining interest rates at 5.25 to 5.5% for around 12 months, the Federal Reserve announced today that they have officially decided to cut rates. This comes on the back of positive inflation data over the past few months, indicating a cooling trend and moving closer to the Fed's preferred 2% inflation target. For instance, last week's inflation report showed that the Consumer Price Index, the CPI, in August only rose by 2.5%, the lowest since February 2021. The rate cut also marks a shift in policy to address a weakening labor market. Jerome Powell mentioned that the time had come to adjust policy. And today the Fed followed through by lowering the target federal funds rate by 0.5%, a larger decrease than anticipated. In this video, we will break down what this rate cut means for the economy. And rate talk can get nerdy quickly, right?
Holy shit, you're a nerd.
Yield curve intention, term premium, bond laddering. It's like a playground for financial geeks, right? But let's skip all of that because most of it doesn't really impact your day to day life. But what really matters are the fundamentals, how interest rates are determined, and how they influence your personal financial choices. We will also dive into what this shift could mean for you, as it may significantly impact your financial decisions. But first, let's cover the fundamentals of what an interest cut actually is, as understanding the implications requires knowing the basics, right? If you already consider yourself as a financial expert and know everything about rate cuts, feel free to skip ahead. But I believe this section will be helpful. So, when you hear the term rate cut, it refers to a reduction in the federal funds rate, also known as the overnight rate, which is the short-term rate at which banks borrow from the Federal Reserve. This rate impacts the interest rates banks offer for loans such as small businesses or mortgages. When rates are higher, borrowing becomes more expensive, leading banks to charge high interest rates to their customers, which discourage borrowing. The federal fund rate can be adjusted by the Fed to influence monetary policy. So, for example, if the economy is struggling, the Fed may lower rates to encourage borrowing. Controversy: when the economy is booming, the Fed may raise rates to prevent excessive inflation. This is what we have seen lately, because due to the surge in inflation following the pandemic, the Fed raised its benchmark rate 11 times between March 2022 and July 2023. The goal was simple: higher rates tighten the money supply, leading to reduced spending and eventually lower prices. As the chart shows, the federal funds rate remained near zero from 2020 to 2022, before rapidly rising during the period from March 2022 to July 2023. And throughout this year, there has been speculation that the rates would be cut as inflation cooled. Still, the Fed, including Jerome Powell, has been cautious not to reduce rates too quickly, waiting for consistent month-to-month data showing inflation trending towards the 2% target. And now, with inflation hovering around 2.5%, the Fed has deemed it appropriate to move toward cutting rates. So, now that we have covered the basics, let's explore what might happen next. Historically, rate cuts are seen as positive for markets, with many believing they boost stock prices. And we already have seen the first signs of this. When we look at the S&P 500, for example, we have had a little spike in the last of these days. But why is that? And what does the data say? Here's a great chart on the history of rate cuts. What you can see here is how the stock market has performed during every rate cut cycle since 1970. There is a lot of variability, but what you see is they highlighted one important distinction: rate cuts that happen during crisis, a recession, or celebration, no recession. Right now, a lot of Americans are employed and they are spending money. So it doesn't look like we are heading into a recession or even close to one. And if history proves correct, we could see the stock market continue to move higher in a slow, grinding fashion. Rate cuts don't always encourage reckless spending, nor do they always cause a market crash. And according to an analysis by Schroders, stock tends to perform well after the Fed starts cutting rates. On average, 12 months after a rate cut, stock market returns are up by 11%. Stocks have beaten cash by 9% in the 12 months after rates starts to be cut on average. Bonds have also been a better place to be than cash. These outcomes are findings of new long-term analysis of investment returns during 22 US interest rates cutting cycles since 1928. The range of historical returns is wide for stocks and bonds, but both have tended to do well when the Fed has started cutting rates. This is largely because lower borrowing costs can benefit companies, particularly smaller or growth-focused ones, which often rely on debt to fuel expansion. When debt becomes cheaper, these businesses and even individuals are more likely to borrow money and invest. However, the impact of rate cuts isn't felt immediately. Even though this week's rate cut was 0.5%, it may take time for effects to ripple through the economy. But it's worth noting that stock market performance is often tied to future expectations. If the market anticipates further rate cuts, those expectations should already be priced in, which may explain why we often see market gains even before cuts take effect. So, what does this all mean for you? If you are investing for the short or medium term, you might try to capitalize on this data by allocating funds ahead of rate cuts. But remember, profits are never guaranteed. Ben Carlson of A Wealth of Common Sense blog explains that the stock market cares more about company earnings than about a couple of Fed rate cuts, and I totally agree with this. The stock market can do just fine during a rate cutting cycle. Low rates don't guarantee the stock market has to keep going up. If you are a long-term investor focused on retirement or similar goals, your strategy probably won't change much, right? And what I have said in earlier videos, staying consistent with dollar cost averaging into broad index funds is likely your best bet for a great future. But where rate cuts can really matter for you is in your cash-like investments. A drop in the federal funds rate will lead to lower yields on things like treasury bills, certificates of deposit, and high yield saving accounts. For example, many accounts are currently offering 4.5 to 5% interest, but after this rate cut, you can expect those yields to decrease. But does that mean you should abandon your high yield accounts? Not necessarily. Many people will still hold on these accounts as long as they yield over 4%. If rates drop closer to 3%, you may reconsider, but ultimately it depends on your investment goals and risk tolerance. Unlike most historical episodes, the Fed is not considering cutting rates because it's worried that the economy is too weak. It is doing so because inflation is going in the right direction, meaning policy does not have to be so restrictive. If it is right and it can engineer a soft landing, then 2024 could be a good year for stock market investors and bond investors. So, what kind of investments do you have? So, let me know in the comments below. And in the next video, we will explore the 26 best investment lessons from Jack Bogle, who has seen numerous rate cuts during his 68 years experience in the financial industry. You absolutely don't want to miss out on that one. See you in the next video.